Miracles! Today we're going to discuss two ETFs that just went up on their dividends significantly. Now, before we get too excited about that, these are monthly dividend payers that go up and down on their dividends every single month. But what I'm really excited about is the fact that these two with last month, seeing all the volatility and the market pulling back on August 5th, kind of giving us a little bit of a scare. These two outperformed and increased their dividends because of that. Now, these two ETFs, JEPQ and JEPI, are covered call ETFs. So, of course, during times of volatility, options premiums are going to pay more. So this is why this style of ETF is something that I do keep in my portfolio because of that downside risk. If we get into a recession, yes, everything is going to pull down, but the volatility will be up and the income that they generate from these options will offset some of that downside risk. So we'll get into a lot of those numbers in just a minute. I wanted to point out too, somebody in the comments mentioned all the doors that I have in my new studio, and I thought it was very symbolic. This is like all of the doors of opportunity that we have to us. We just have to take advantage of them. There's a lot of opportunities that are out there. Just take a look, open your eyes, see what's out there, and go and get it. All right, so the two ETFs that we are going to discuss today are JEPI and JEPQ. These are JP Morgan's covered call ETFs. JEPI is going to cover the S&P 500, and JEPQ covers the NASDAQ 100. So these two are covered call ETFs based upon those two underlying indices. Now, the benefit of these is they are going to generate some significant income. As of the time of this recording, JEPI has a little bit over an 8% yield, and JEPQ has a little bit over a 12% yield. But the downside is when the S&P 500 is going on a bull run, these two will have their upside capped due to the fact that they are out of the money covered calls, which gives them a little room to run, but they cannot capture the entire run all the way up because you're trading off that upside for the income. So first we'll look at JEPI. And as you can see here, this is just the price return over the last 5 years compared to the S&P 500. The S&P 500 is in the orange and JEPI is in blue. So you can see it tracks it along the way, but definitely significantly underperforms from a price standpoint. And then in the last 2 years, JEPI basically stayed flat while the S&P 500 had been moving upward. But now when you compare it to the total return, and this is including all of the dividends that you have paying out for JEPI, you can see it still underperforms, but not by anywhere near as much. You can also see that in 2022, when the S&P 500 was down significantly, JEPI basically stayed sideways, a little bit of a dip, and actually outperformed at some times during that year. So again, this is just showing us that, yes, overall, S&P 500 is going to give you a better total return, but if you are seeking income and some downside risk during volatile times, JEPI and JEPQ and these covered call ETFs could be a good way to go when it comes to that downside risk mitigation. And now here's the dividend history. So as I said, it does go up and down significantly when it comes to their dividend payouts. So it fluctuates from month to month. And this month here has seen a significant jump. And this month here, JEPI has seen almost a 38% increase in their dividend payout. Now, you look at the kind of trend, it looks like it's trending downward. But again, this was also during a very big bull run with lower volatility. So when we get to higher volatility times and the S&P 500 is on a down year, look at what happened in 2022. You saw the payouts going up and up and up. And as we saw with the price performance, it was basically even and outperformed at some times. So if we are anticipating a recession or more volatile times, heck, just the next 2 months alone with the election, we are going to see some volatile times. We could see some payouts increasing on this ETF. And now the same thing is going to hold true for JEPQ, which is based off of the NASDAQ 100. And now JEPQ is not as old as JEPI. So JEPQ just came out in May of 2022. So we have a lot shorter history here, but compared to the NASDAQ 100, it's basically flat. Again, it does trend a little bit along the way with it, seeing a little dip here on August 5th, but it doesn't come anywhere near performing as well as the NASDAQ 100 itself, as far as strict price return goes. And even when you look at it from a total return standpoint, it still does significantly underperform. But when you look at the timing of it, since we just started in May of 2022, that was at the time where the NASDAQ 100 was still sliding down a little bit. But basically since then, the NASDAQ 100 has been on a tear. So there's only a few months. So the thing here that I'm paying attention to is that downside risk mitigation, because don't forget, the NASDAQ 100 is going to be more volatile than the S&P 500. So when we see downside coming, if we get into a recession, the S&P 500 will pull down, but the NASDAQ 100 will pull down even more. So that's something to pay attention to. And if JEPQ is going to be acting very much like JEPI, again, you can see just here on August 5th, that dip where the NASDAQ 100 fell significantly, JEPQ did not fall anywhere near as much. Now we are looking at that very large increase in their dividend payout this month. So looking at a time of extended volatility, we could see the NASDAQ 100 fall down significantly, but JEPQ hold up strong, especially with higher payouts. And now JEPQ's dividend increase this month is 29.5%. So again, a nice jump up here based on the volatility we saw last month. And again, we have been seeing relatively consistent payouts, up and down a little bit here and there. But looking back at the times when we saw some of the most volatility in the market, like last October when we saw the bottom of the market, the payout was the highest. And this is by dollar amount. This isn't just by percent, because I don't like to go by percent when it comes to my dividends. Yes, I like to see that percent increase. But when I'm looking at my actual payouts, I don't pay my bills and I'll try to reinvest my money with percentages. I reinvest and I pay my bills with dollars. So when the market was at its lowest, JEPQ was paying out its highest. So we saw that volatility again last month. Looking forward, if we are going to see continued volatility with the elections and a potential recession, this payout could go up even more. So JEPI and JEPQ are two of my favorite covered call ETFs that I have in my portfolio. And now for covered call ETFs, their expense ratio isn't too terrible at 0.35% each. So you're basically paying someone else this money in order to generate that income for you. So it's a bit of a trade-off for me, but this is also why it's not going to be a main part of my portfolio. It's going to be there in the initial parts of my portfolio as I build it, as my stable income, to have income coming in to be able to build up the rest of my portfolio between long-term ETFs like VU, VYM, SCHD, and other dividend-paying stocks as well. And I can also use that money to buy some growth stocks like Tesla, TSLA, SoFi, and Palantir. So I like to utilize that money to kind of filter out everywhere else. I do not have the drip on, that is the dividend reinvestment. I don't have the drip on for any of my stable plays like JEPI or JEPQ. I just kind of stockpile that cash. And then for you guys who have seen my previous videos showing how I run my entire portfolio, I take that cash and I just see where I need to put it. Do I need to put it in cash? Do I need to invest it in a certain area? I see which different stocks and ETFs are dipping. On those dips, I purchase there. Of course, I do my due diligence to make sure that those stocks and ETFs aren't dipping for some fundamental reason. But if they're just underperforming because whatever, they've fallen out of sentiment, there was some negative news that the company is going to get over, an opportunity to buy the dip, that's where I'm going to take advantage of that with that cash. And right now I'm building up my cash pile even bigger because, again, if I'm anticipating the election time coming up, I think the next 2 months we could see some very good buying opportunities. And if we get into a recession in 2025, I have this stockpile of cash ready to be able to distribute and deploy into these companies and ETFs to be able to build my portfolio even stronger. Because don't forget, fortunes are born during bear markets. If we are going to get into a recession, we will be seeing a bear market. At that time there, I want to be able to have cash on the sidelines and a lot of this cash flow coming in. Again, JEPI and JEPQ, seeing historically that they usually go up higher on their payments during those volatile times, that will give me more cash flow coming in to be able to take advantage of those opportunities in the market. So this is why I'm running my portfolio the way it is. This is what I see from JEPQ and JEPI right now. Things can change. You guys need to do your own due diligence and research on those two to see if they are right for you. But let me know in the comments below if you own either of these two ETFs. Thank you guys so much for watching. I appreciate all of your support. Have a great one.